Hey, good morning. This is Mayor Valensky with Driving Markets. So yesterday the market started up slightly up, and then over during the day and especially in the close, they were absolutely trashed. Now there's many viewers are saying that, oh Mayor, that it's the end of the bear market, because on Friday the Dow shot up so much, all the markets shot up. They thought that is it. It's all over. The investors thought it was absolutely rosy. We're going to have lower inflation, lower interest rates, and it's going to be no recession. But you can see by the volatility of the market is in two-way traffic. It's being pulled in two directions. And of course, there's going to be up days, and of course, there's going to be down days. You have to remember, anything said in this piece is an opinion. It's my opinion. It doesn't mean it's fact. It doesn't mean that, oh, you've got to go and act on it. I'm just giving you a general macro and maybe micro indicator as to where the market is going. But it doesn't mean that if the market goes up, I'm wrong, or if the market goes down, I'm wrong. It's not matter if I'm right or I'm wrong. I'm just trying to give you some overall guidance. So those investors and those traders who are sending me text messages saying, oh, you've got it wrong, you were calling it a bear market, it's going up, that's fine. If the market turns around and now becomes a bull market and you're long, well, great, good luck, excellent, you made some money. That's the whole idea of this channel, is to get you to act and hopefully make you some money. It's not there to lose your money. It's trying to get you to make some money, give you some guidance. So why did the markets come off yesterday? Quite simple. There is poor consumer confidence. The consumer overall in the States does not have a lot of confidence that we're not going into recession. In fact, there's many analysts, one of them, Cathy Wood, said that we are of ARC, said we're already in a recession effectively. Well, recession is really measured by negative GDP over a two-quarter period, and we haven't had that yet officially. Now, we could be in recession, but you have to remember we've got full employment out there, and as long as you have full employment, it's unlikely that you're going to have a significant downturn in the economy. And there's some countries are so short of staff, they're paying the staff bonuses to join the business. We're not talking about banks, we're talking about regular jobs, whether it's waitresses or whether it's truck drivers, whether it's bus drivers. There's a massive shortage of work, a massive shortage of employees and staff. And that's based on several factors. During Corona, a lot of people left their professional established work in order to go and either join another industry which was more stable or look to make more money. For example, there's one of the guys I was speaking to, a young guy. He was making around about £20,000 a year working in an office. He now became a food delivery guy, and on food delivery he's making £35,000 a year on tips. So why would he go back to his job? He said he wants to save up some money, which is great because tips is cash. So that's just an example of where there's been a movement of labor from one industry over to another. So there's a shortage of staff globally, whichever country you go to, whether it's in the UK, Europe, or the US. And as long as there is a shortage of staff, then you could have a buffer to a recession or a downturn in the economy. Remember, the economy is being affected mainly by a supply chain factor, which was caused by the corona, Chinese flu, pandemic, COVID, whatever name you want to attach to it. That was the main starting point of the supply chain issue, which is fed on to all other parts of the economy. So let's talk about the markets, where they're likely to go. So the markets are range bound. I said in the last few days, trade the range. You've got an upper side and you've got a lower side. So as the market comes down until that range is broken, you could, for example, sell at the top, trade it down with limit orders and stop losses, and then you could close out at the lower end, then you could go long at the lower end and move up. Of course, there's a danger that once it breaks out of that range and you're the wrong side of it, you could end up losing quite a few quid. But at the moment, the markets are range bound. The areas I would look to get into is definitely look at the Bitcoin. It seems to be stuck at the upper range of close to 22,000 and the lower range around about the 19,300. It could break down below that all the way down to 17,000. If it does, then it's probably going to go much further south. But that's a good trading asset. The other one is FX. Go long of the dollar. The likelihood of the dollar is going to go up. And even though it might have a down day here and there, the trend overall is up on the US dollar. Look at oil. OPEC, wow, let's look at 1 second. Saudi Arabia and the UAE is at maximum capacity, so you might be looking to go long of oil, because oil, in my opinion, is going to go well above the $120, $130 level. So there's a couple of assets there you can trade. Also on the high-tech stocks, you might want to go short of Tesla, Amazon, and Netflix, because they've had a little bit of a rise recently. You could be going short on those. That's more or less it. I'm trying to keep it less than 6 minutes. This is Mayor Volensky with Driving Markets. Catch me on Instagram, Twitter, YouTube. Subscribe, like, pass comments, have some feedback. Enjoy it. Have a good day.